This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm Financial Standard journalist Andrew McKean, here with SG Hiscock portfolio manager Hamish Tadgell. How are you going?
Very well, Andy. Nice to be with you.
So, look, today we wanted to speak about a reflection on the reporting season that happened at the end of August, and maybe starting with, what are some of the standout themes and trends that you observed from reporting season?
Look, I think overall, Andy, what we'd say is it was a resilient reporting season in a tougher economy. We certainly saw decelerating growth, top-line growth from a lot of companies, sticky inflation and costs, and increasing margin pressure. And really that reflects the bifurcated nature of the economy, I think, at the moment. And that was also reflective across the bifurcated performance of we saw in a lot of companies. If you look at it at an aggregate level, earnings, EPS growth, downgraded about 3 or 4% across financial 24 and 25. But I think the important thing to note is if you look back over the last sort of 18 months, EPS growth or earnings growth for the market is down closer to sort of 15, 16%. And so we've had this period of sort of gradual cuts, if you like, but, growth is certainly slowing. I guess the offset to that is that, valuations continue to push higher. And we certainly saw that through reporting season 2. Clearly has been a strong feature of markets recently.
So do you kind of see that continuing as well? Is that something you would forecast that will continue, that, earnings per share will continue to decline, valuations are continuing to climb?
Yeah, look, I think we do expect the, economic growth continue to slow. And clearly, central banks are very conscious of that. And I think that's factored into their thinking at the moment. I guess the challenge in Australia is that we continue to have this sort of inflation that's proving sticky. And there's a number of homegrown factors here, I guess, into like the NDIS, immigration, and I think, the big infrastructure boom that we've seen that are feeding into services inflation here. And clearly that's causing the RBA to continue to push back against reducing rates at this point. And so I think, the setup in Australia is slightly different from what we're seeing perhaps in the US at the moment, which is, I think, ahead of the Australia in terms of the cycle. They've clearly already started to cut rates. But I think here, the risk is that the economy continues to slow as financial conditions continue to remain quite tight. And really, it's the key, I guess, to it all is really unemployment or employment growth. And I guess back to my earlier point about the resilience of the economy, I think that's been driven by very strong employment growth. It's been very robust. And I guess the question is, that is starting to ease. And I guess the question is the economy is going to be very dependent upon just how that plays out over the next 6 months, I think.
Perhaps from your perspective as well, were there any kind of major surprise packets that came out of the reporting season period, whether that's company specific or something else?
Yeah, sure. Look, I think retail and the retail performance of the retail stocks was surprising, and I think that I would say it was bifurcated. But again, I think that just reflects what I was saying before about the strong employment growth, but also the fact that mortgagees and savers are doing it very differently. And so you've got this part of the economy that continues, particularly in the baby boomer and the retirees, that continues to do very well. And on the other side, the mortgagee side and I guess the lower income earners are doing it a lot tougher. In terms of other things that surprised us through reporting season, we came out of reporting season a lot more positive around sort of the REITs. We think a lot of the headwinds in that sector are turning to tailwinds. But what we have seen is increasing transaction activity starting to emerge. We've seen some basing of cap rates. So asset valuations are more supportive of book values now, and we're also starting to see rents starting to stabilise. Another area which we sort of were more positive coming out of reporting season was just the healthcare sector. We're actually starting to see volumes return. It's been a long grind out of COVID for a lot of the healthcare operators. And areas like sort of diagnostics and particularly in radiology side there's good momentum or good improvement we're seeing in some of the volumes there, and that's certainly been supportive for those type of stocks.
Just before, when you were speaking on REITs, what were some of those headwinds that have turned into tailwinds?
The primary one is interest rates. So REITs, tend to have quite a bit of debt. They're quite leveraged, but they're also, clearly on the valuation side, very leveraged to what bonds. And with rising bonds and rising rates, that has been a big valuation headwind as well as an earnings headwind in terms of higher interest costs. So clearly with the Fed's decision to cut rates, and I think an expectation that rates are probably close to or peaked here and the next move is down, that's certainly supportive for the REITs.
I guess going forward as well, then, given what you've said, what would you kind of recommend for investors to be considering? What risk should they be concerned about? I know you were speaking about unemployment rates before. Is that something that you see as kind of a primary concern going forward?
Look, I think, if I step back for a moment, the macro is still pretty uncertain and there's a fair bit of volatility out there. The geopolitics clearly is it's very heightened at the moment with what's going on in the Middle East and the like. And we've had a lot of elections and, elections, typically politicians, a lot of stimulus type policies. And so it's been quite a complicated macro environment to navigate. I guess one of the things that we would say is that really trying to dial down the noise and focus back more on the fundamentals. And growth is slowing, as I said, but in our view, it's not suggesting at this point, particularly with sort of rate cuts starting to come in the US, that there's a hard landing coming. We're still very much of the view that we're sort of on more of a softer landing. And that's really supported by the rate cuts, as I've mentioned, but also the fact that fiscal policy remains very active and dominant. So, post-COVID, governments are spending a lot more on welfare redistribution, but also on trying to basically stimulate the consumer and assist the consumer where they can. So I think our broad comment is really that, at the moment, the economic setup is really one of slowing growth, but not sort of moving towards a recession, with supportive, Fed and central banks and governments being quite supportive as well. And in our view, that creates the opportunity for really the market to probably continue to extend in terms of breadth. And in particular, areas like small caps and resources, which have dramatically underperformed over the last sort of 12, 18 months, we see good opportunity for them to over the next sort of 12 months.
And why specifically with small caps? Is it just a matter of valuation?
Again, that's partly it. I guess it's confidence around earnings in those businesses. But we also see that when central banks do cut rates, small caps tend to outperform. And, we've really been in a bear market for small caps over the last sort of couple of years. And so that increased confidence, I guess, just that is brought about by those rate cuts should start to see small caps perform better. I think the other area, which, as I mentioned, is resources. So resources has really clearly underperformed a lot in the last 12, 18 months. And that's really been driven by a couple of things in our view. Firstly, those concerns about slower growth. Slower economic growth generally means less need for commodities. I think the second thing is just China. And China's been very soft. What we've seen clearly with the rate cuts is that, again, that helps economic growth. It should be a tailwind for economic growth. And with the Fed cutting, we've also seen China really pivot in the last couple of weeks around sort of talking about fiscal stimulus. And I think a lot of that's been brought about by really probably the currency differential, interest rate differential that's opened up with the Fed cutting.
One other thing that I wanted to talk to you about, and this is a slight pivot, and that's about the Australian consumer as well. Now, it seems they're in reasonable shape. I mean, that is despite, a pronounced period of higher interest rates and a cost of living crisis as well. But if we're specifically talking at, cost of living pressures, where are these pressures most pronounced? And is it across, different demographics, age groups?
Yeah, look, I think that's right. It's been I would say very bifurcated. So as I mentioned before, at one level, you've got lower income, younger cohorts and mortgagees, interest rates rising, cost of living rising, is really seen that those groups squeezed. On the other side, those without a mortgagee and more savers, and in a lot of cases retirees or might call the baby boomers, are actually benefiting as rates rise. We've actually got more income as rates rise. And we're certainly seeing very different behaviours in terms of how they're performing at the moment. Interesting, Flight Centre's a company during reporting season, just listening to the CEO, he was talking about the fact that, high-end cruises are sort of off the chart at the moment in terms of volumes. I think that really speaks to that retiree and that sort of, that sort of, as I said, baby boomer sort of cohort. On the other end, corporate travel is doing it pretty tough at the moment. And I think that just reflects probably, companies looking to save where they can. And travel's always one of those things that typically sort of gets cut first.
And just as a final point of order, I guess, but what are you most interested in looking forward? What's kind of got your eyes open?
It's, as I mentioned before, rates certainly is an area which we've become a lot more constructive on post reporting season. Resources is another area, and clearly with the stimulus, we've seen a big rally. And we need to be a little bit careful about sort of how quickly. And I don't think what China's done is a sort of I can call it a sort of bazooka to sort of, saving the economy or global growth. There's still a lot of issues in China in terms of stagflation, deflation, etc., which they're working through. But it certainly makes us more constructive around the resource side, particularly given the valuation side gap that's opened up between banks and resources. That gap is probably the highest we've ever seen, and banks have been beneficiary, I guess, of rising rates, but also very low bad debts as the economy has been pretty resilient, as I've spoken about, and resources we've spoken about. But I think that gap has certainly closed a bit in the last week, and I think has got some more to go. The other thing, which is more a structural theme, which we really focused on at the moment, we're big believers in, I guess, two things. One is sort of the digital transformation and the energy transformation. So on the digital transformation, I think it's sort of undeniable the sort of the use of data, the growth in data is been exponential and will continue. And AI is clearly adding to that. But the question is how get exposure to that, particularly in the Australian economy. And we're very interested in the sort of the data centres. We've got a number of investments in companies like NextDC and Infratil, which owns the Canberra data centres, which we think continue to look very positive. And then on the energy transition side, again, we think that the theme is sort of undeniable. And the question is how you get exposure to it. So we're big believers that gas is part of the transition and providing part of the firming capacity, I guess, for economies. Renewables will be important, but we see gas as being important. We've got a number of investments across that area. We've also got invested in companies like Worley, which are service providers to that space, who are doing a lot of renewables consulting work. And then, again, companies like Infratil, which are actually the owners of things like wind farms and solar. They've got a business in the US called Long Roads, which has got a lot of exposure to this area, and we think is really well positioned to benefit from the Inflation Reduction Act and a lot of the investment that's been made and policy in the US, but just more the broader thematic as well.
Okay, that's really interesting to know. Thank you so much for your time, Hamish. We really appreciate having you on.
Andy, thanks. It's been a pleasure.
Ta.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.